There's an old saying on Wall Street that you should sell in May and go away. But what if I told you that this old adage might actually be doing more harm than good? Let's start with the facts, and I want to shout out Renaissance Macro for their amazing chart on seasonality in the markets. Now, from 1928 to 2025, the returns in May are a relatively flat percent win rate, although we did just have our best month of May since 1990. Now, for the month of June, things turn a bit more bullish and we average about 80 basis points of return. Although the win rate in June is very similar to May and the monthly average throughout the year, June tends to be a pretty strong performing month. Now, July, on the other hand, is even stronger with 150 basis points of return and a win rate of 61%. Therefore, instead of dialing back your risk in May, you might actually be stepping away from two of some of the strongest months of the year in the market. June and July aren't just decent, they're reliable contributors to annual gains. Both of these months' average return sits above the long-term average gain, and July's return is actually the second best month in the entire year behind December. Now, because big institutions often deploy fresh capital, think end of the quarter portfolio rebalances and mid-year portfolio adjustments, demand for equities may pick up in these months. Therefore, again, if you're looking to just sell in May and take the summer off, you could miss out on what historically has been a very powerful rally. Now, although July is an incredibly strong month for the market, this may be the best time seasonally to try to take some profits and some risk off the table. This is because later on in the summer months, liquidity can actually thin out in the markets as traders and big institutions may go on summer vacation, and momentum begins to slow a bit in August, then leads to the worst month of the year for stocks, which is September. On average, September has a negative 120 basis point return and a win rate of under 50%, just sitting at 45%, which is well below the monthly average return line. Now, October, while slightly positive, is known to be pretty volatile and can be choppy for trading. This is because many fund managers' fiscal year ends in October, so they take tax loss harvesting and may sell equities that have performed poorly throughout the year. This is so that they can realize losses in these positions and offset these for some capital gains in others, all while rebuilding their portfolio and setting up positions for end of the year and into the next. Therefore, combined with lighter summer liquidity, these may explain why September and October shape up to be rougher times in the year for the market. So here's the bottom line. May, typically flat, although we just passed their strongest May since 1990. June and July are typically very strong months and ones that you want to typically have risk on going into these months, with again a caveat of July being a good time to start to ride out that momentum to the upside and take some profit, while looking for some momentum to slow in August and potential opportunities throughout August, September, and October to put that cash back to work if you get dips or further corrections. Now, let me be clear, seasonality does not guarantee anything, but it can be a helpful tool when managing your portfolio and making decisions on where momentum may be going. If you can understand the seasonal rhythm in the market, it could help you capture more of the runs to the upside and potentially sidestep some predictable seasonal selling. Now, as always, let me know your thoughts in the comments and like and subscribe for more content and more context.